David and Michael are both 30. They live in Dallas. Each earns $85,000 a year, receives a 4% employer match, and contributes $10,000 annually to a 401k. Both invest in the same low-cost index fund. Both earn an average 8% return before fees. Both keep investing for 20 years. David chooses traditional. Michael chooses Roth. David says, "Why pay taxes today when I can keep more of my paycheck and pay later?" Michael says, "Why accept a future tax bill when I can pay now and make qualified withdrawals tax-free?" They both sound confident, but they are both missing the number that decides the comparison, the tax rate applied to the money when it comes out. This is not a prediction of future law, and it is not personalized tax advice. It is a framework for comparing the two accounts. The answer changes when your income, tax bracket, employer plan, withdrawal strategy, or behavior changes. 4% of $85,000 is $3,400. So each year, $13,400 enters the retirement account, $10,000 from the employee, and $3,400 from the employer. For this simplified example, the employer match is identical for both men. In many plans, employer contributions are held in a pre-tax source even when the employee chooses Roth. Some plans may offer Roth employer contributions under current law, but the plan has to allow it. Always check the plan document. That means Michael may choose Roth for his own contributions and still have a taxable employer match bucket waiting for retirement. Now the crucial fairness issue. A $10,000 traditional contribution and a $10,000 Roth contribution are not the same paycheck cost. Traditional contributions generally reduce current federal taxable wages. Roth contributions are made after tax. So if David contributes $10,000 and Michael contributes $10,000, Michael normally sacrifices more take-home pay today. To keep the story simple, we will first compare the account balances when both put the same $10,000 into the plan. Later, we will compare what happens if David actually invests his tax savings. That second comparison is where the debate becomes honest. Suppose David is in a 22% marginal federal bracket. A $10,000 pre-tax contribution could reduce federal income tax by roughly $2,200 before considering deductions, credits, payroll tax details, and the fact that tax brackets are progressive. It is not a guaranteed refund, and it is not necessarily $2,200 added to his paycheck dollar for dollar. It is an estimate of the federal income tax effect under the assumption. Michael contributes $10,000 to Roth. He gets no current federal income tax deduction for that contribution. His paycheck feels smaller, but the contribution enters the Roth account after tax. At the end of the first year, if contributions are made at the end of the year and the fund earns 8%, the $13,400 combined contribution is worth about $13,400 before growth timing and fees. If contributions are made earlier, the result is higher. The key point is that the investment performance is the same. The tax treatment is different. Using a simple model, $13,400 contributed at the end of every year, 8% annual growth, no fee drag. The approximate account values are: Year 1, $13,400. Year 3, $43,502. Year 5, $78,612. Year 10, $102. Year 20, $613,210. These are illustrations, not forecasts. Real markets do not deliver 8% like a metronome. Contributions may happen every paycheck, fees reduce returns, salaries change, and employer matches can have vesting rules or limits. Notice what the model says. Before withdrawals, David and Michael have the same account balance because the money invested and the return are the same. Their statements can look almost identical, but an account balance is not the same as spendable money. If David's traditional account reaches about $613,210, the balance is not automatically his after-tax spending amount. Traditional withdrawals are generally included in taxable income. If his effective tax rate on a withdrawal were 22%, a simple illustration would leave about $478,304 after tax, assuming every dollar were taxed at that rate and ignoring other effects. Michael's Roth balance may also be about $613,210. If the distribution is qualified, Roth 401k contributions and earnings are generally withdrawn tax-free. For a designated Roth account, the IRS generally requires the 5-year holding rule, plus a qualifying event such as reaching age 59 and a half, disability, or death. The details matter, especially for early withdrawals and rollovers. So, at a 22% future tax rate, Roth appears to win on the account itself. But that statement is incomplete because David received a tax benefit on the way in. Traditional is not pay tax twice. The contribution generally avoids tax now, the investment grows tax deferred, and withdrawals are generally taxed later. Roth pays tax before the contribution and generally avoids tax on qualified withdrawals. The central question is not whether tax exists. The question is which tax rate applies, and what happens to the tax savings along the way. Suppose David saves approximately $2,200 in federal income tax each year because of the contribution. What does he do with it? If he spends it, buys a larger car, or lets it disappear into monthly lifestyle inflation, the traditional strategy is being compared against Roth with an advantage removed. David kept the tax benefit, but he did not preserve it for retirement. If he invests the full $2,200 at the end of every year in a taxable brokerage account earning the same 8%, that side account could grow to approximately $100,676 after 20 years before taxes on dividends and capital gains. That is why a fair traditional versus Roth comparison cannot look only at the 401k statement. But the brokerage account is not another Roth. Its returns may create taxable dividends, and selling appreciated investments can create capital gains. Its after-tax result will depend on the investments, holding period, tax rates, and how withdrawals are managed. Now the mathematical twist. If the current tax rate and future withdrawal tax rate were exactly the same, and David invested the full tax savings with no tax drag, the two strategies can be very close. The pre-tax dollars are simply being taxed at different times. Roth does not automatically create extra wealth. It creates tax certainty on qualified withdrawals. Traditional does not automatically create extra wealth. It creates current tax relief and a future tax obligation. David's contribution deduction is generally valuable at his marginal tax rate, the rate on the next dollar of income. Retirement withdrawals move through tax brackets, so the effective rate on the total withdrawal may be lower than the marginal rate he paid while working. That difference is why traditional can be powerful for someone earning a high salary today and spending much less in retirement. Imagine David's income rises to $320,000 during peak earning years, while his retirement income later comes mainly from moderate withdrawals. A deduction during high tax years followed by withdrawals across lower brackets may be attractive. Now imagine Michael is early in his career, earning $55,000, but expects decades of promotions and higher income. Paying tax at a relatively low rate today and securing tax-free qualified withdrawals later may be attractive. Neither example proves the answer. It shows the right question: what tax rate are you avoiding today, and what tax rate are you accepting in the future? Future taxable income is not just a 401k withdrawal. Add Social Security, a pension, rental income, interest, dividends, a spouse's retirement account, business income, and required minimum distributions. Traditional money can also affect the tax treatment of other income. Depending on combined income, part of Social Security benefits may be taxable under current rules. Higher income can also affect Medicare Part B and Part D premiums through income-related adjustments. Those surcharges are based on rules and thresholds that can change, so do not build a decades-long plan around one current table. Traditional accounts are also subject to required minimum distribution rules under current law. The general starting age is 73 for many people, while later birth cohorts can face a different age under current legislation. Roth 401k rules have also changed over time, so confirm the current treatment when planning. The practical point is simple. A traditional balance can create taxable income even in a year when you would rather keep withdrawals low. This is one reason spendable income planning is more useful than bragging about a large account balance. Pause here. Imagine both accounts display $613,210 on the same morning. David needs $50,000 for the year. He withdraws it from traditional. The withdrawal may increase taxable income and could interact with Social Security and Medicare rules. Michael withdraws $50,000 from a qualified Roth account. That withdrawal is generally tax-free and generally does not increase federal taxable income in the same way. But now change the story. David has a low-income year and carefully withdraws money through lower tax brackets. He may pay much less than 22% on the withdrawal. Michael paid his tax years earlier when the Roth contribution was made. The better result depends on the complete lifetime cash flows, not one screenshot. The account type is a tool. The withdrawal plan is where the tool becomes valuable. If the future is uncertain, an all-or-nothing bet may not be necessary. Many workplace plans allow employees to split contributions between traditional and Roth options. That creates tax diversification. For example, David could direct $6,000 of his annual employee contribution to traditional and $4,000 to Roth. The exact split should be based on his bracket, cash flow, goals, and plan options. In retirement, he could draw from traditional during lower income years, use Roth for a large purchase, and use taxable savings for expenses with more flexibility. This approach does not eliminate taxes. It gives him multiple sources with different tax characteristics. It can also make it easier to manage income around Medicare premiums, Social Security taxation, and future tax bracket changes. A Roth conversion may be another planning tool. Converting pre-tax money to Roth generally creates taxable income in the conversion year, so it is not free. It may make sense in a lower income year, but the decision requires careful bracket management, liquidity for the tax bill, and attention to current law. Never sacrifice an available employer match just to make a tax argument. If the plan matches contributions, contribute enough to capture the match when financially possible, subject to the plan's rules. The IRS adjusts contribution limits over time. For 2026, the basic employee elective deferral limit for many 401(k) plans is $24,500, with separate catch-up rules for eligible older workers. David and Michael's $10,000 employee contribution is below that limit in this illustration, but viewers should verify the current limit for the year they contribute and distinguish employee deferrals from employer contributions. Also check vesting, matching formulas, Roth availability, investment fees, and whether the plan's match is deposited pre-tax or Roth. A tax label cannot compensate for a plan with poor fees, limited investments, or a missed match. Here is the mistake that drives most online arguments. People compare a traditional balance with a Roth balance as though both dollars are identical. They are not identical if one balance includes a future tax liability and the other does not. But the opposite mistake is also common. People compare a $10,000 traditional contribution with a $10,000 Roth contribution and ignore that the Roth usually costs more from the paycheck. The complete comparison has three parts. First, compare the dollars entering each retirement account. Second, account for what happens to the traditional tax savings. Third, estimate after-tax withdrawals using a realistic retirement income plan. Leave out any one of those, and the answer can be misleading. Question 1. What is your current marginal federal and state tax rate? Do not use a generic internet bracket without checking your actual situation. Question 2. What income will you have in retirement? Include Social Security, pensions, rental income, taxable investments, and a spouse's accounts. Question 3. Will you invest the traditional tax savings? If the answer is no, do not award traditional and imaginary side account advantage. Question 4. Do you value certainty? Roth can provide a pool of qualified tax-free money under current rules. Traditional can provide immediate tax relief and may be better when your current tax rate is much higher than your expected retirement rate. Question 5. What behavior will you sustain? The best tax strategy is weaker than the strategy you fund consistently. At age 30, nobody knows the exact tax code, income, health expenses, market returns, or retirement spending pattern they will face decades from now. A mix can be more resilient than a prediction. Now consider a decision that may matter more than arguing traditional versus Roth online. Suppose either investor increases retirement saving by $2,400 per year, $200 per month, and earns the same assumed 8% return for 20 years with contributions at year-end. That extra saving could grow to approximately $109,829 before taxes and fees. The actual result will vary, but the lesson is durable. Contribution rate, time, fees, and behavior often matter more than winning a theoretical tax debate by 1 percentage point. If an account choice helps you contribute consistently, capture the match, avoid panic selling, and increase savings after raises, it may be the better practical choice for you, even if a spreadsheet under one narrow assumption favors the other. David is not automatically smarter because he gets a deduction today. Michael is not automatically smarter because qualified Roth withdrawals can be tax-free. David may win when today's tax rate is high, retirement income is lower, and he invests or deliberately uses the tax savings. Michael may win when today's tax rate is low, future income is higher, or tax-free retirement cash flow is especially valuable. A blended strategy may win when nobody can confidently predict the future. The real comparison is not traditional versus Roth in the abstract. It is your current tax rate versus your likely retirement tax rate, adjusted for behavior, income sources, legislation, and withdrawal strategy. So before choosing, do not ask which account is universally better. Ask, where am I likely to pay the tax? How much will I contribute? And will I actually keep the advantage? That is the number most people miss. Tax rules, contribution limits, required distributions, Medicare premiums, and Social Security taxation can change. Speak with a qualified tax or financial professional about your own facts and verify current IRS and plan rules before acting. If this breakdown helped you see the hidden math, subscribe to Wealth Blueprint and turn on notifications. In the next video, we can run the numbers on Roth conversions, conversion ladders, and how to combine traditional, Roth, and taxable accounts without guessing. Because the best retirement decision is not the one that sounds smartest online. It is the one that leaves you with the most useful, spendable money for the life you actually plan to live.